Hello fellow traders, 'tis I, the Rumpled One. I've had some people send me emails to my Gmail account and they want to know, they just don't understand the whole concept of horizontal lines and where to put the stop loss. And to me, as I said, it's a very simple concept, but simple and easy is not necessarily the same thing. So I've been thinking about this a while, and I came up with something that I think might help. The further away price is from the stop loss, the smaller your position size. Let's use an example. Let's say we're looking at a chart. Now, doesn't matter what the time frame is, and let's say price did something like that. Well, let's just say at this point in time, we're right here. This hasn't happened yet. So, you have two questions. Which way are you going to trade? And where are you going to put your stop loss? Well, if you're trading short, this is the only place that makes sense to put your stop loss. Why would you want to put your stop loss there? Because it's obvious price could do this. So why would you want to put your stop loss here? You just get stopped out. So as price starts to move away from this high, and if you're going short, the further you let it move away, the smaller your position size. See, what will happen is that'll keep your stop price the same, and it'll keep your risk the same. Because see, this is what's key. On the other hand, let's say you're looking at the chart and you're right here. Well, here's the low. Okay? So the further price gets away from this stop loss, the smaller your position size should be. And so what that gives you is an opportunity to ride out the trade. Because what's the worst thing that can happen? Is you get in the trade and then it does this, hits a stop only to do that. That's what you don't want. Now, of course, you don't know what's going to happen. It could also do that. But the point is, we know this is a low. This is the lowest low. So why not use that information? If you do this, especially if you Forex traders, you might wind up in a position for weeks or months, but you're not stopped out. You might wind up in a position where if it normally would have triggered you out, it took off, you might be looking at 100, 200, 300 or more pip profit over the course of a week or two. All because instead of using these hard and fast stop loss rules that just wind up taking you out of trades, you stood back, you look at the charts, and you say, hey, this is like maybe an all-time high, or this is the high over the past 24 months. I'll use that as a high. Of course, you're going to have smaller position sizes the further away it gets, but you'll have more profitable trades. So I hope this clears up some of the confusion and some of the questions out there, because it really is a very simple concept. Because we're using the old risk formula, but what we're doing is we're going to play with the position size, and we're going to put a fixed point, only point on the chart that makes sense to put that stop. Because you hear about people talking about pullbacks to MAs and all of that, most of them get wiped out. So instead of thinking about using some indicator as a pullback, we'll just use simple data such as a highest high and a lowest low over a long period of time to determine our stop loss. In fact, one of the things, a new indicator that I wrote, It was basically tells you how much data or how much time you're looking at the chart, how many bars you're looking at. If you're looking at 100 bars of data, is that enough? If it's an hour chart, 100 hours of data, is that really enough? But if it's a week chart, hey, 100 weeks of data, that might be enough to base your trade on. So anyway, once again, doesn't matter what you trade, it's how you trade it.